And now let's look at the financial sector in Nigeria. Low interest rates, high effective tax rates, and competition from telcos and fintechs are some of the top risks that Nigerian banks are likely to face in 2022, and that's according to a report by Renaissance Capital. Well, we have to elaborate on that report, Adesoji Sholanke, Director of Financials, Tech and Fintech at Renaissance Capital, joining us now from London. Hello, Adesoji, good morning.
Morning. Good to be here.
Good to have you. So tell us about this report. How did you arrive at your findings, and what method did you use? Bring us up to speed with that.
Sure. So Renaissance Capital, we're an emerging and frontier market focused investment bank. We have colleagues on the ground in different markets in Africa, including Nigeria. I sit in our London office. Basically, there's two primary ways you could approach equity research. So one way is to take a top-down approach. Another way is bottoms-up. We basically adopt both methods, but we typically think of ourselves as specialists in the bottom-up approach. So a lot of speaking to people on the ground, speaking to companies, speaking to regulators, speaking to the companies that we cover as well, and also spending a lot of time trying to understand the numbers. So that's pretty much how we approach research, if I'm to simplify the process.
And then your findings shows that you call it low interest rates is also a risk that the banks are to face this year, 2022. But at 11.5%, a lot of people would say that's not a low interest rate.
Okay, I believe you're referring to the central bank policy rate. So that's correct. It's indeed 11.5%. But you also need to look at the makeup of the balance sheet of the bank. What actual assets sit on their balance sheet and what actually earns an interest. So if you break that down, what you find out is that about 40% of Nigerian banks' total assets sits in cash reserves and central bank special bills, which basically earn 0% to 0.5%. That's nothing, right? So that's 40% of your total assets earning close to nothing. Then you need to start to look at what else is left there. When you then start to look at interest earning assets, you look at treasury bills, you look at bonds. On the treasury bill side, on the OMO instruments, the yields there range 8 to 10% thereabouts, but the central bank hasn't been doing aggressive open market operations. On the federal government treasury bills, the interest rates there range between maybe 2 to 5%, somewhere in that range. The interest rates are on the T-bills are still very low. On federal government bonds, interest rates there are north of 10%. Okay, but that also brings with itself its attendant liquidity risk. So when you bring all of this together, what you saw last year was that net interest margins for the banks did collapse. They reduced by, I believe, about 80 basis points for the banks that we look at. Looking ahead, we don't think the outlook for interest rate is the upside. We think interest rates probably stay somewhat flattish this year, which means that the outlook for margins is probably they stay the course. We're also just 1 year into elections, so that also means that the central bank probably maintains its current posture around the policy rate. So that's our view on the outlook for margins and overall interest rates for Nigerian banks.
Just wondering, the newly introduced income tax, what impacts will it have in that space?
Which income tax are you referring to?
The
are you
one,
referring to the? Go ahead.
Yeah, the one that's just been introduced, fixed income space for investments
Okay.
there, yeah.
Okay. I believe what you're referring to is the waivers on interest earned on fixed income securities.
Yes,
So
fixed
yes,
income
that's correct.
securities.
Okay. So those waivers ended in January 2022. They had a 10-year window. So the banks and indeed investors in those instruments, they've enjoyed about a 10-year period of waived interest on waived taxes on interest earned on those federal government securities. The only thing which has been exempted now is FGN bonds, but pretty much everything else going forward, taxes will be charged on the interest that is earned on those securities. So what that simply means is that the effective tax rate of the bank is expected to go higher. Okay, banks that have a relatively higher proportion of their interest income coming from federal government bonds, they will bear a lesser tax burden. So banks like Access Bank and probably UBA. banks that tend to have a significantly higher portion of their interest earning assets, or should I say liquid securities in treasury bills, for example, they'll bear a higher tax rate, right? So I'm talking maybe banks like Stanbic, GTBs, Zenith, for example, they'll probably have a relatively higher increase in their tax rate this year and going forward.
So that's another squeeze on their liquidity and their ability, to reach out to the real sector.
I would say it's probably more that it slightly reduces their ability, how much dividends they could pay. In terms of what could hurt their capacity to lend, our concerns are probably more around the introduction of Basel III, which is currently being tested on by the central bank. And that simply means that the banks will have to set aside additional capital buffers to meet the Basel III requirements. The other thing that could somewhat constrain the bank lending is that elections are coming. And that simply means that a bank should start to exercise some caution around lending in this environment. And there's also been COVID, and indeed the economy is recovering, and we think that's positive. And we did see strong credit growth last year of about 18 to 20%. But we think this year about 10 to 15% is what we're expecting in terms of credit growth for the banks in 2022.
So we also have the credit reserve rate, the CRR, which is at 27.5%. And a lot of analysts have said that that is also a limiting factor for the banks.
Indeed, and the cash reserve has been quite punitive. It's only gotten worse for the last 5 years. And what the cash reserve ratio means, if I'm to simplify it, for every 100 naira of deposit, or every 100 naira of naira deposit that the bank takes, the bank needs to keep a portion of that at the central bank, earning 0%. When you say it's 27.5%, that means that for every 100 naira of deposit that the bank takes, 27 naira 50 kobo needs to be kept at the central bank, and the bank earns no interest. But because the central bank has been charging additional cash reserve for different reasons, whether it's ad hoc or based on certain rules around loan to deposit ratios, what that simply means is the effective cash reserve of the bank at some point was as high as 50%, right? Just think about that for a second. So half of your naira deposit, you can't do anything with it because you keep it at the central bank earning 0%. But today, the effective rate is about 40% plus or minus, depending on the bank you talk to, which is still quite punitive. The central bank has also introduced special bills, which means that in addition to this 40% number, you have another about 11% of assets, which you are earning 0.5% on. So when you look at the balance sheet makeup of a bank, banks are basically a spread game, right? So you take low-cost funds and you're looking for a way to earn a higher interest on your cost of funding, and you earn a spread. So when your spreads are collapsing by that much, that hurts the ability of the banks to generate earnings. It affects the ability to pay dividends. What this has meant is that over the last couple of years, Nigerian banks have had to be quite innovative in their thinking. And the reality is we have to give them thumbs up for this, because when we look at banks in other markets, they tend not to understand how to respond to changes in the macro environment. Nigerian banks have done a great job here. It's still been very challenging. We've seen evolution for holding companies, more efforts around generating non-interest revenues, whether it's trading income or even from fintech or non-bank financial services areas. So these are things I think the banks will continue to do, which is positive. They have to respond because the regulatory posture we do not think will change soon, at least not before election.
And in spite of this, we still have about 36% of Nigerians not included on the banks. So this, of course, is another lose out for the banks.
Indeed, and these numbers keep coming up in terms of financial inclusion, etc. So let me give you some statistics, because I think the problem is not financial inclusion and probably more economic inclusion. So if you look at the World Bank stats, they say if you look at the international poverty line of $1.90 per day, Nigeria has the largest number of extremely poor people, overtaking India in 2018, right? Which means Nigeria's poverty rate was almost 50% in 2018. Another statistic from them, so half of all Nigerians work in the agriculture sector, and half of the people working in agriculture belong to the poorest 40% of the population. 4 out of every 5 Nigerians are own account workers, and most of them work in the agriculture and services sector. Almost half of the poor live in the Northwest, and the North itself accounted for 87% of all the poor people in the country in 2016, according to the World Bank. The final statistic is that 64% of all the poor people lived in rural areas, and about half of the rural population lived below the poverty line in 2016. So what does all of this mean? It means that to really crack financial inclusion, if I'm to call it that, you really need a low-cost business model, because if you are a profit-making enterprise, the cost of serving or reaching tons of poor people has to be very low. Otherwise, you struggle to make economic sense of serving a lot of these customers. And this has been the case for the bank. So I think of what the banks have been doing, or should I say the competitive landscape in the country. This is why telcos getting involved in whether it's via mobile money or a PSB license makes sense, because what the telcos have is they can provide an alternative store of value to bank accounts, right? Which means that, and this is because the telcos already have a very strong penetration to very poor people, because a lot of people do indeed have mobile phones, even though they do not have bank accounts. So the telcos can basically leverage that connectivity to then sign up these people into a store of value, which will be a mobile money account, or indeed a PSB type bank account, because PSBs are technically banks. So that's my thinking of how all of this evolves. So, and I think we have to give the central bank kudos. On financial inclusion, they have been very progressive in their efforts to get this up and running over the last decade plus.
So from your perspective now, the banks shouldn't see the telcos and the fintechs as competition, but, complementary.
Both of them actually. So telcos will be competition, very, very fierce competition for that matter. But at the same time, the reality is there's room to collaborate, because the telcos will probably not be able to offer the entire scope of offerings that they would like to. They will need to leverage some of the existing banks to provide certain services, etc. But the telcos, the one advantage they do have is they have a massive outreach into customers. MTN alone, for example, has 75 million customers, right? You can argue around what percentage of that is active, but that is the high-level number that that MTN alone provides. When you think about all the people that have BVMs, it's only about 50 million people, right? So telcos getting involved in PSBs can indeed be significant competition for the bank. But one thing you also need to keep in mind is that the Nigerian banks since 2019, with the establishment of CNF, what that has meant is the banks have also been able to build up an alternative last mile reach to telco agents. Okay, so First Bank, Access Bank, or let me put it this way. There are 3 pillars of the agency banking model that are taken up in Nigeria. So there's bank-led agents, there's telco-owned agents, and you have independent agents like, Paga, Timat, e-settlement, OPay, etc. So all these elements are operating at the same time. So what all of this means is that the evolution of mobile money in Nigeria will be very different from how it has evolved in other markets, where telcos are typically the only game in town. In Nigeria, all 3 elements are active, and everyone is competing for the same piece at the same time. What that could also mean is that the economics of the business model gets constrained very quickly, because it's going to be highly competitive. But we'll see, So that's why we're all interested in how all of this plays out. But yes, telcos will be competition, but there's also room to collaborate with the bank.
And what role does Inera play in all of this? I mean, I guess one of the objectives of introduction of Inera by the CBN was financial inclusion of some sorts.
I see the cynicism on your face, but the Inera does have some role. One of the things that you have to give the Nigerian Central Bank kudos for is they try to lead from the front. Okay, so it might not be a perfect solution, but at least they are trying this out to see where they end up. Now, if you look at some of the numbers that have come up so far, if you look at the stats that was released by the central bank late last year, a lot of the transactions so far have been bank to customer or customer to bank transactions. And this is primarily because the banks have really been the ones marketing this Inera. To get the Inera up and running at scale, you need a couple of things. You need not only that people download those wallets, for people to be encouraged to download the wallet, the Inera needs to have a superior value proposition versus the alternatives that exist in the market. So that's the first thing. The second thing is when you go beyond customers downloading it, you also need recipients, so whether it's a merchant, for example, to be able to accept the Inera as a method of payment. So what that means is, do you need QR codes? Because the Inera operates via a wallet. It's a digital method of payment. So on the acceptance side, you need to also solve for merchants being able to accept the Inera. So is this a contactless method? Is this QR codes? What form is it going to take? So all of these things need to be solved for, and we're not there just yet. So it's very early days. We have to see, but Nigeria is testing ground once again. So fingers crossed.
Yes, yes. I think we're the first in Africa. Zimbabwe is trying to follow suit. We hope they don't overtake us, so we become the first, but we don't see the effectiveness. That's always our fear. Well, thank you so much for joining us on this conversation. Adisa Jishulanke, Director, Financials, Tech and FinTech at Renaissance Capital. Thank you so much for sharing your thoughts with us.
Thank you. Bye.